Podcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. This is Tony Butler with Insurance Agency Marketing Services. I'm the Life Sales Director here, and I want to thank you for joining our webinar today. Today, we're going to be discussing infinite banking concept with Kip Walker with Mutual Trust. Now, we had a huge turnout on the last infinite banking webinar that we did, and that posed a lot of questions from agents. So I wanted to revisit that, talk a little bit more about it. But before we do, I need to go over some housekeeping items. I'm going to be really brief on the housekeeping items so we can dive right into it. So again, thank you for joining our webinar. My name is Tony Butler. I'm the Life Sales Director here. And first thing I want to point out is you as an agent, I'm sure referrals are very important in your business, as well it is with IAMS. So when you refer an agent to us and they do get contracted with us, we do provide you with the $50 referral bonus. Any business that they do write on the carriers they are appointed through IAMS, you do get a 20 basis point referral bonus. So if you have any questions regarding that, feel free to give me a call. We also have, if you are a new producer, we have what's called New Producers Builder, help you grow your production. Now we have three different levels. We have the $100,000 level, the $300,000 level, and the $500,000 level. So within those levels, you can get a $750 cash bonus on the $100,000 level. There are mailers that are available on the $300,000 level, and we do offer not only mailers, but we do offer coaching on the $500,000 level with two of our top producers, Matt Gill, Dave Pimper. If you want to bypass all that on the $500,000 level and take the Ritz-Carlton travel package, that is a neat thing for you to have. So if you want more details on that, please feel free to give me a call. Now, we also have back office support here in IAMS. We help you work smarter, not harder. We have business building tools available to you. We, as sales directors, help you with case designs. Our websites do provide forms at your fingertips. Also available on the websites is life and annuity quoting information. And we offer top sales expertise coaching and paperless contracting. So feel free to call us regarding that. We also have a creative marketing solution department, and they do an outstanding job of helping you market your business, rebrand your business if that is the case. If you're looking for online marketing projects or personal website assistance, they're able to help you with that. Please call Jacob. His team can help you in that area as well. Now, I did mention previously about our website. Our IAMS website is a 24/7 website. We have excellent sales tools available to you. We do have a term and universal life quoter on our website. It is always accessible. We do have forms available for you online. And for those of you agents that write annuities, there is an annuity grid available. Also current annuity news and a long-term care product grid for those of you agents that are interested or writing long-term care insurance. We also have a retirement analyzer. Our subject matter expert on that is Marcus Solar. He's one of our annuity sales directors. What this retirement analyzer helps you help your client do is answer certain questions such as, can I continue my present standard of living into my retirement years? When can I retire without running out of money? And how would it affect my family if I die prematurely? With this, we do offer a 30-day free trial. Please feel free to reach out to Marcus in regards to that. We also offer it free for annuity producers producing $250,000 in annual premium, or if you're an annuity and life producer producing $250,000 in single premium life premium. We also have an IAMS wealth management team. Wealth management team does help your clients strengthen your relationship with them. It does improve client retention and increase revenue for you as the agent. Feel free to give Charles Jr. a call in regards to that, and they can provide you with more information. We also have a life and annuity academy that we conduct quarterly. This upcoming September 18th through the 20th, we're having another Life and Annuity Academy. It's going to be in Des Moines. What the Life and Annuity Academy does is it allows you as the agent to attend. The charges are picked up by IAMS. It's a free trip for you as the agent. We talk about sales ideas and strategies. We do have top producers that come in and speak to you. And if you like to get a little bit more information on that, I do have a survey question for you. If you could just answer yes or no if you like information on our Life and Annuity Academy. I'll give it a few minutes while you guys answer that question. And if you have additional questions regarding the Academy, feel free to give me a call as well. Give it a couple more seconds before I close this out. Okay. Looks like we're good there, so I'll go ahead and close that out. Thank you. And lastly, we have our IAMS 2019 Marketing Summit. It is going to be August 25th through the 29th. It's in Naples, Florida. The invitation period is from January 1st of 2018 all the way to June 30th of 2019. We have a bunch of agents that have already qualified for this trip. You're eligible with any of the combinations listed here. If you have questions regarding your eligibility, if you think that you're close to being eligible for the trip, please don't hesitate to give us a call. I'll be more than happy to provide you with additional information on that. And with that, I am going to turn this over to Kip Walker, who again is with Mutual Trust, and we'll be talking about the infinite banking concept. Just one moment while I change Kip. Sorry, Kip. While I change Kip over to the presenter. Okay. Kip, you there?
I am here, yes.
Okay,
I'm going to go ahead.
I see your screen. So I'm going to go ahead and mute myself and have at it.
Well, thank you, Tony. I appreciate you hosting this call today, and everybody who joined. I appreciate you taking the time to do that. I know it's your time's valuable, and want to make this call as valuable as possible. I am the Regional Vice President for the Midwest with Mutual Trust, and we are going to be talking about the infinite banking concept. This is a very powerful concept. It represents roughly 60% of our business overall. So Mutual Trust is very good at this concept, not only promoting it, supporting it, but administering it. And we are designed, Mutual Trust as a company is designed to do this business. So I encourage you to take notes as we go through this presentation. It's going to look good. Some of this stuff is going to be impressive, but that doesn't matter if we can't make it work for you. And to do that, I need your help. I need you to take notes, ask questions, write some names down of individuals who are on your calendar, on your desk, in your files, and think about those who would be a great candidate for having this discussion. And that will be our basis for moving forward and making this a successful time spent. We'll take a look at the infinite banking concept, and then we'll talk about how Mutual Trust supports IBC. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it. That's Robert Kiyosaki. He is the author of the Rich Dad, Poor Dad series. We like that quote because it really encapsulates what we're trying to do, create wealth for generations. And this concept really helps to do that. Infinite banking is not a new concept. J.C. Penney used it. They used it to make their payroll during the Great Depression. Walt Disney used it when he couldn't find anybody else to finance his new project for Disneyland. And Disneyland or Disney World, I always get those mixed up. But anyway, he didn't have any backers, so he used his cash value life insurance. Ray Kroc used cash value life insurance, his whole life policy. That's all there was back then, his whole life. He used whole life policy to start McDonald's. Doris Christopher started Pampered Chef out of her garage. And then she sold her Pampered Chef to Warren Buffett, I believe, for billions of dollars. So it's not a new concept, but what we have done and what actually Nelson Nash has done is popularized it and brought it to the mass affluent or even the masses. It's a concept that is tried and true. And Nelson Nash, who unfortunately passed away a couple months ago, we have been partnering with him to promote the infinite banking system for many years. I think it was over 15 years, something like that. And so we have a really great relationship with the Infinite Banking Concept organization, Nelson Nash's organization. So what is the infinite banking concept? It's a financial principle based on U.S. tax laws and insurance contractual guarantees. Now, what does that mean? Basically, this won't do it justice, but it's a simple way to describe it. It's a pool of capital in a specially designed whole life contract that allows the client to reduce their tax burden, reduce their interest, and provides them with access to that capital anytime they need it. And that's important. I mean, if you want to get a loan and you're in trouble, banks love to give us money then, right? No, they don't want to give us money when we really need it. They want to give it to us when we already have it. So, or when we don't need it. So it's important to build up this pool of capital, but to do it in the right instrument. And that's what whole life is. It's the perfect instrument for this concept. So access to capital is key, as I just said, for financial prosperity for individuals and for businesses. Where are clients keeping this money now? If they're not getting a loan from a bank to get it, as I mentioned, then they're storing it somewhere. Well, are they storing it in something that's liquid? Does it have guarantees? Is it being taxed? Is it leveraged? Meaning, is it doing anything else for the client? We'd like to say giving your dollar more than one job to do. Will it still grow if they use it? And that's just really a reference to how you access that capital, which we'll talk about. So here's where a lot of our clients are keeping their money, right? They're keeping it in CDs, savings accounts. They're earning, maybe in CDs you can get like 2.5, just, not too bad. But then they're getting taxed on top of that. And, Uncle Sam's taking their whatever percent hit at the end of the year through 1099. So, but it's not doing anything else for them, whether it's in that savings or CD, maybe in a money market, spending efficiencies, or cash. Of course, you can't make any money in cash because it's just eroding in your hand, and you can't really make any money off of just holding in cash. That would be a bad idea, right? People used to, in the Great Depression, I think they used to bury it in the backyard. So not a good move there. But anyway, it's in banks of some kind, right, with those guarantees. We think that a better alternative is participating whole life insurance, and only participating whole life insurance. It has the guarantees that provide the certainty that they need, comparable guarantees to what you would find in FDIC insured accounts. Insurance companies have their fund that they pay into to protect their policyholders. And so those guarantees are very strong. In our case, we use a product called Horizon Value. It's our flagship product for cash value growth. And if you compare Horizon Value's cash value on the guaranteed side of the ledger versus any of our competitors, anyone out there, bar none, our cash value is higher than their cash value plus their dividends in the first 6 to 10 years. That's very powerful, and that's why we are so well known. That's one of the reasons we are so well known and used for the infinite banking concept. The product design is important, but you also need to be able to get to that cash value. So liquidity, use, and control are terms that we say a lot, because once you have the cash value in there, excuse me, I had to hit the cough button there. Once you have the cash value in there, you need to be able to access it when you need it. And mutual trust puts no restrictions on when the client can access that cash value. And with infinite banking, it's typically through loans. It's almost always through loans. You take a loan against the cash value, and then you can do that within 10 days of setting up the policy. So the clients have that access that they need, and they know the money's going to be there, and they can access it tax-free. Like I said, through loans or withdrawals. Typically with infinite banking, it's through loans until they get retirement. So we have an answer, we have a solution, but if the client doesn't understand they have a problem, then they're not going to be listening to us for very long. So how do we get them to see the problems that they have, the issues they're facing? Well, business owners need access to capital, whether it's to expand their business. They might need it for inventory. They may be saving up money in a savings account and spending that money down to zero or whatever amount and buying their inventory and then saving up again. Okay, maybe that's really not the most efficient way to do things in many cases. Do they have money to cope with emergencies? What if you get sick or become disabled? Do you have money accessible at that time? What if you are the breadwinner in your family and you lose your job and somebody gets sick, or you just need access to capital to keep the bills paid? How do we get them to keep more of what they make? Many individuals and families and businesses, they are spending away so much money in interest and taxes. How can we help them to recoup that money? How about dealing with the limits of qualified plans? Qualified plans are good. I mean, they're not bad things, but what do they really do? They defer taxes, but they also defer the tax calculation. Many of us assume, or many assume, that taxes are going to be lower in retirement, but there are studies out there showing that that's not necessarily the case. And so what do you really get out of a qualified plan? Well, you defer the taxes, but once you get to the finish line, Uncle Sam's taking their cut and they are participating in the write-up the whole way. So yes, take that. If it's a 401k plan and the company pays a match, absolutely take that. But above the match by the company, is that really the best use of your funds? It's not accessible when you need it. I know you can take loans against your 401k, but if you lose your job, you got to pay that money out. It's a distribution and get with a penalty, and you can only take about 50% anyway. So it's really, there's a lot of issues with qualified plans. And it's just not the infinite banking concept can provide solutions for those, for limitations on those qualified plans. How about debt? Debt is a huge problem in this country and probably many countries, but it's just huge. It's an enormous problem. How do we redirect that debt into our own personal economy, into our savings, and help grow our wealth? We can show the client how to do that. So what's the biggest problem facing Americans? It's how do I save for retirement? And also, I would add that how do I save for retirement and help my kids go to college? And so these are huge problems that our clients are facing. Huge headwinds are preventing them from achieving these goals. And when you look at what that issue is, in many cases, it's more than just, I can get you another 1% or 2% on your investment. Come put your money with me. How much risk can I introduce into your financial plan before you hate me? That's the story that's being told. How do you grow your business in a market, in a life insurance market in particular, that's growing at about 2%? You can start telling a different story. And infinite banking is telling that different story by talking about things like interest and taxes. So roughly 34.5% of every dollar you spend is going to interest. Don't you think maybe there is more opportunity in reducing that interest burden than in getting 1 or 2 more percentage points on your investments? And so that's one of the most powerful things that we can do with the infinite banking concept, is to reduce that interest burden. And when you look at interest, and how it's paid. We often talk about interest rate, and that's important. But the infinite banking concept takes a different look at it, and it looks at the volume of interest, the volume of every payment you make, and how much of that is made up of composed of interest. So with a car loan, it's roughly 30% of every payment you make. With credit cards, roughly 40. Mortgages, it starts out really high at 83%. So just think about all of that interest we're paying away. That money is gone and out of your hands and cannot be used ever again, and will not be able to earn whatever percentage return you're getting on your investments or savings. So that adds up to over $15,000 a year for the typical family. Over 20 years, that's $306,000. Mr. and Mrs. Client, I can show you a way that we can recoup maybe a third of that by implementing the infinite banking concept. So here's the thing with financing. I talked about either draining a savings account or taking a loan from a finance company. Well, the truth is that you're financing in both strategies. Whether you are not earning interest, you're losing interest on a savings account when you take the money out, or you're paying interest to a finance company, a bank, or what have you, when you get a loan. They're exactly the same cost. As a matter of fact, if I take $10,000 out of a savings account earning 3%, or I get a loan, and let's say I can get a loan at 3%. If I pay that loan back over 5 years, and I replace the money in the savings account over 5 years, if the interest rates and loan rates are exactly the same, the cost is exactly the same. Just in one case, you're building up the $10,000, draining down to zero. In the other case, you're just going below $10,000 below the zero line, and then paying the loan back to get back to zero. The infinite banking concept proposes a more efficient way, a better way to take loans. Instead, what you do is you collateralize your purchase. You collateralize that pool of capital that you have. And you could do that with a savings account or a CD, but you're still going to have to go to a lender. You're still going to have to qualify. It's going to show up on a credit report. They might say no. They control the terms of the loan repayment. They can call that loan anytime. Okay, with infinite banking, none of those things are the case. Your policy has a pool of guaranteed capital. The client can take a loan against that capital or policy anytime. They send in a one-page form. They get their money in a few days, like 3 days, not very long. They can pay it back however they want. They can miss a payment. Nobody's going to come looking for them as long as they have the cash in their policy to back it. And it doesn't show up on any credit report. It doesn't impact your credit at all. It doesn't even show up. It's a private contract between the insurance company and the client. And that's another unique aspect of it. Government has a hard time messing with private contracts, but they can mess with your 401k and things like that, those qualified plans. I don't know if any of you remember when Obama was in office, and after the bailout, AIG, I think it was, had received a bunch of money, and then they went and paid some of their top executives millions of dollars, and everybody had a fit. And Obama came out and said, I looked into it. There's nothing I can do about it. It's a private contract. So, that's a powerful thing when you have something that's a private contract, and contract law is very strong in the United States. So you maintain control over those funds, and very difficult to mess with it. That liquidity, access, and control at any time. You can take as many loans as you want. We do not limit the loans you can take, and that's a big deal because many carriers can't handle it. They'll say, yeah, we'll take infinite banking business, and then what they're really saying is they'll take the application, because once those loan requests start coming in, they start pushing back, and we've heard that over and over again. So we are built for this business. And of course, you receive an immediate tax-free benefit for your children or grandchildren or whoever the client insures or uses as their beneficiary. So yes, this is life insurance, and they get the opportunity to pass on a legacy that's guaranteed to happen. There's no escaping whole life. What's going to happen is going to happen. Guaranteed. It's in the contract. You can see it all the way through, up to age 120 in most cases, that the cash value is going to match the death benefit at age 120. And so that cash value just keeps marching forward. So you have a powerful additional benefit there. You also have You also have waiver of premium and things like that we'll talk about in a minute that add even more security to this whole concept. So there's no fees, there's no red tape in this concept. And again, you can get your cash as soon as that policy's funded, as soon as the check comes in, and the cash shows up in the cash value, you can get it. In most cases, it's 10 days due to the banking, banking require, getting the accounts shifted around. Check takes a while to cash a check, is what I'm trying to say. But once the money's in there, you can access it. So, who is our client for the infinite banking concept? And by the way, before I dive into that, we can design these policies to be extremely cash rich. So when I say that, we've designed policies that were paid in 2 payments. Let's say $50,000 in year 1, $50,000 in year 2, and then year 3 or 4 you have positive cash value growth guaranteed. So that you don't get a lot of those policies, and you really crush your comp when you design it that way. But I'm just letting you know that there is a tremendous amount of flexibility in the design and use of these policies. This isn't your great grandfather's whole life insurance, and we'll talk a little bit more about that in a minute. But who are we looking at for clients? We're looking at small business owners. Business owners really get this. They understand capital, especially real estate investors. They love it. They love that access to that capital to expand their real estate. Doctors, dentists, and other professionals really understand it as well. We had a situation where a dentist during the financial crisis, his business was down because his clients were losing their jobs and they couldn't afford to come in and get the dental care that they needed in some cases. So he had a company that he could use to finance their treatments, but they charged more interest. And this was a family dental practice, and he knew his clients, many of them, and the ones he felt comfortable with, he started making loans against his policy, his IBC policy that we had set him up with. And he was able to charge them not only a rate that was fair, but more than what he was paying on his interest. We charge 5%, by the way, on our interest. So he was on our loans. So he was making loans at 5%. He would have them pay back maybe at 5 or 6 or 7 or what have you, plow that back into his policy and grow his wealth and also grow his business, because now those clients were able to come in and get those treatments, and he was making money off the clients for their treatments and also for any interest that he got from them, excess interest. So again, the client profile is really almost anybody that has a decent income. I would say roughly 70,000 in household income. That's going to be a client. But again, businesses really do appreciate the concept. And clients who are just looking for safe alternative assets. Whole life is an asset class now. Banks use it for their tier 1 capital. Their safest capital. A lot of it goes into whole life insurance because they know the guarantees are strong. And plus the additional benefits that we talked about with it growing income tax free and can be accessed income tax free. It has additional benefits that I'm going to show you. And so as a safe alternative to other assets out there that fluctuate with the market, and whether it's the housing market or the stock market, bond market, what have you, it's an alternative to all of that. Those who desire to protect their family, this is life insurance, so obviously that's a big part of this as well. But we do have some infinite banking practitioners who don't even really talk about the life insurance component of this, which is kind of interesting. But I mean, this is life insurance, so that is a very powerful part of it, because if you have $1 million set up to go to your children, grandchildren, charity or whatever, that's going to happen. Well, that gives you the permission to spend down every other asset you've saved for retirement, right? Because that $1 million is going to be there no matter what. And so now, since you have this other asset there, you can increase your retirement distribution, and also leave a larger legacy. So again, there's just lots of additional benefits here. The additional features are guaranteed premiums, guaranteed cash value, as I mentioned, paid up additions riders. So these, if you're not familiar with whole life, these are paid up additions riders are the answer to the cash accounts in the indexed UL or the UL, except it maintains its guarantees. So what happens is you can think of a paid up additions rider as a single premium paid up policy that's incredibly flexible. You can put up to $500,000 in the single version and $100,000 annually into the annual version. You can put that money in anytime. As long as you put $100 in to the flexible version, it's active and stays active to age 90, and you can put as much money in as you want. You put that $100 into these paid up additions riders, whether it's the single or the flexible, you're going to immediately see $94 in cash value. It earns 4%. Okay, the base policy earns 4% as well. Now, that's on the cash value, so keep that in mind. So on the base policy, that 4% is a gross number, but as the cash value shows up, any cash value that's in the policy is earning that 4% in that year. Okay, but there are expenses being taken out prior to the money getting into the cash value. With the paid up additions rider, you're getting a lot more cash showing up for a given premium. Remember, I put $100 in, you see 94, that earns 4%. You're seeing that because the paid up additions rider buys very little death benefit, so there's much lower cost of insurance. You can put the money in, you can withdraw it out, which again, that's not part of the infinite banking concept. You could do it if you wanted to. There's no surrender charge. There's no waiting limit or anything. You can just put it in, take it out whenever you want. You can really build a lot of cash value into these policies using those paid up additions riders. And so what the typical infinite banking concept structure looks like is 60% of the premium goes into the paid up additions rider. 40% goes into the base. So if you have $10,000 in premium total, $6,000 goes into the paid up additions rider, $4,000 goes into the base. Because of that use of the paid up additions rider, roughly $5,700, something like that, would show up in the cash value immediately due to the paid up additions rider. Okay, so we can get cash value building pretty quickly. Many times clients will have $10,000 sitting in a savings account earning 2% or 1%, and then they'll have $10,000 in credit card debt or something like that. So sometimes we can shift that money and then take a loan against the policy to pay off the credit card debt, just to get that policy started. And then, or they may just have $10,000 sitting around that they want to have available in an emergency, but we can take some of it, maybe $5,000, and move that in to get the policy kick started, and then start paying, some of those higher debts that we have and recouping some of that interest. Now, to really take full advantage of the infinite banking concept, I kind of alluded to this earlier with the dentist example. You want to act as an honest banker. That's Nelson Nash's term. So you have your bank set up. Your whole life policy is your bank. And let's say you're a business and you need a loan. And the best alternative you could find was a small business administration loan. And you're going to pay anywhere from 6 to 10%, depending on the size of the loan and how long you take to pay it back. Well, let's say 8% in your case. You have access to capital at 5% from your policy. So instead of taking the SBA loan at 8%, you take a loan against your policy at 5%, and you start making repayments back to that policy at the 8% level. So that way you reduce the debt much quicker. It frees up more cash for you to use later in your policy. And we could even design a paid up additions rider that could allow you to put more money into that paid up additions rider. That difference between the 5% and the 8%, that's 3%, 3 percentage points, which doesn't sound like a lot, but it's actually more than half of your interest being recouped. So you could take that 3 percentage points of interest that you're paying back into your policy, and you can put it right into the paid up additions rider. So there's different ways you can do this. You can pay down your loans quicker, or you can put it into the paid up additions rider and build your cash value quicker. Both ways work. Paying down your policy loans quicker is easier to do, but either way you can do that. And so that's kind of being the honest banker and really taking advantage of the infinite banking concept, putting it on steroids, actually recouping interest that those finance companies were using to get rich and putting it into your own pocket to make you wealthy. Additional features: waiver of premium. how many of our clients actually have actual guarantees in their financial retirement plan? What portion of your retirement plan is guaranteed? We have the ability to do that, to guarantee a portion of their retirement plan with waiver of premium. And also for the paid up additions rider, it's called the disability benefit rider, but they both behave very similarly. So with the waiver of premium, if a client is unable to do their own occupation for 2 years or 5 years, depending on which one you choose, then mutual trust will pay the premium for that client. After the 2 or 5 year period, the standard becomes a little harder to meet. It goes to, okay, if you can't do your own occupation, but you can still do a comparable occupation given your level of training and expertise, if you still can't even do that, then mutual trust will still pay your premium. Okay, so that's what the 2 year and 5 year mean. It's just a higher standard. But mutual trust will continue to pay those premiums if the client can't work. We're going to keep paying the premium for the client. Same is true on the disability benefit rider for the PUA, the paid up additions rider. 2 years or 5 years, looking at their being able to do their own occupation, and then after 2 years they're still disabled and can't even do a comparable occupation, then we're still going to cover their premiums until the policy is paid up. So think about how powerful that is. We have the ability to make sure that a portion of their retirement plan is going to be funded, because in that paid up additions rider, you can use a disability benefit rider to cover the paid up additions rider up to $15,000 in premium. So let's say your client has that $10,000 premium they're paying, $6,000 into the PUA rider, and $4,000 into the base. They have waivers on both. They become disabled. They are guaranteed to have that funding continue up to $6,000. That full $6,000 will be covered, because remember the ceiling is $15,000. But so they'll have that full $6,000 covered, and the base premium of $4,000 will also be covered. That will be paid. And just think about how powerful that is. Even if you can't work, a portion of your retirement plan is going to continue to be funded. And it's not just like a waiver of premium, waiver of deduction with the IUL and ULs, where they just freeze the policy in place. They don't take expenses out, but they don't add any cash. This is actually adding cash as if the client is paying the premium. Really cool thing is if they are not even funding the paid up additions rider to the maximum level they're allowed. Let's say they're funding the minimum. They say, okay, I'm paying the $4,000 base, and I want to just pay $100 to keep the PUA rider active because I had a bad year in sales. I need to take a break. Even if they kept doing that and paid $100 minimum every year, if they became disabled and went on to the waiver, mutual trust will fund the maximum, the $6,000, into the paid up additions rider. Think about how powerful that is. They're not even funding at that level, but mutual trust is going to come in, or if they all of a sudden can't work, and they're going to fund to the maximum $6,000 level. And again, that cap goes up to $15,000 if you have a paid up additions rider that big. It would cover the full $15,000. Just depends on the size of the paid up additions rider. Accelerated death benefit. Terminal illness, that's pretty common. You can get 50% up to $250,000 of your face amount if you're terminally ill. Chronic illness rider, we've introduced this a few years ago. It's very powerful to have that chronic illness benefit. The way that works is the client can accelerate the death benefit anywhere from 5% to 24% on up to $1 million in coverage. So if they have a $1 million policy, they can get up to $240,000 of that per year until the policy is depleted down and to $10,000, and then it's paid up. So the thing is, it's a free rider. It's included on all of our whole life policies, table 4 or better, automatically. And it's a no-fee rider. So what they do is they adjust the death benefit down in the background. They do an actuarial adjustment down. So depending on when you access that rider, if you're going for the max you can take every year, you're going to get all of it the first year. You'll probably get all of it the second year. Third year and fourth year, you probably get something less. And we can't tell you exactly what that is. There are examples, I think, out there, but you don't know exactly what's going to be because we don't know when they're going to access it. So that's the trade-off. But it's still a fantastic benefit for those who just are not going to pay $5,000 or $6,000 for long-term care and worry about the premiums going up and they're never using it, or they don't qualify for long-term care. We had a client that had Parkinson's disease, if you can believe that, and he qualified for the chronic illness rider because it's underwritten for mortality, not morbidity. So if you're older, say 72, I think it is, then we may make you do a test where you stand up, walk across the room, sit down, that kind of thing. But other than that, most clients, it's really, there's no underwriting for it. We're just underwriting the policy for the death benefit. So again, that's another feature that allows the client to protect themselves and their family from sickness, illness, disability. We are very dedicated, Mutual Trust as a whole is dedicated to the infinite banking concept. We have a coordinator. His name is Richard Weiserick. He is also our business coordinator, business planning coordinator. So he is a wealth of information on infinite banking and business planning. And he's responsible for training and things like that with the infinite banking concept. We have software that allows the client to show different scenarios of loans being taken out, repaid at different interest rates. So you can really take a look and see how the plan in action. We have several training programs and selling systems that we actually partner with that have an infinite banking component to it. So there's access to that. And we have marketing materials as well that talks to the client about, or lets the client answer some of the questions or ask some of the questions on what is infinite banking and how does it work. Plus, you have a strong mid-sized company. Mutual Trust merged with Pan American in 2016, and it's been a fantastic merger. Mutual Trust has grown at 12% compound annual growth since that merger. I mean, think about that, an industry growing at 2%, and we're growing at 12% compounded annually. We have $6 billion in assets, $1 billion in capital and surplus. We're A-rated by AM Best and Fitch. So a solid carrier. We have a niche concept in the infinite banking concept. We have other products as well, and we that are beyond the scope of this call, but infinite banking is a really big part of what we do, and nobody really does it better than we do. So hopefully you can identify a couple of clients who fit this profile, set up a call with Mutual Trust through Tony or Tony, I'm sure he's going to give out some contact information, and give it a try once. Think of a client that you could try this with. And if you try it, the premiums are substantially higher than your typical cases. And we had one client through IAMS. When IAMS first got on board with Mutual Trust a few years back, we had one advisor jump on infinite banking and started using it, and he qualified himself and IAMS single-handedly for our conference. And we are not above bribery. Our conferences are awesome, and it's a great opportunity for you to double dip as well and get a chance to get 2 trips on one dime, going to Naples, and then you can go on a cruise. Or actually, the cruise would be first. I think ours is before IAMS. But if you sign up through IAMS and start writing, for the first 4 months, we double your credit, and it's not that onerous. It's very generous the first year actually to qualify. So if without that double credit, if you wrote $70,000 in business, base premium, that is $70,000 in base premium, that would get you to the Mediterranean cruise that we're going to next year. In the first 4 months, since we're doubling it, if you did all your business, qualifying business in the first 4 months, you just have to write $35,000 in base premium, and that would get you on a Mediterranean cruise. Think about that. That's awesome. So we're going to stops in Spain, Italy, and France. And my son is excited. He says, I have to qualify. He's 13. He's like, there's no drinking age drinking age limit in Italy, which I don't know if is even true. He's like, so am I going to get the drink, Dad, if we go to Italy? No. But anyway, these cruises these trips are fantastic. They treat you like kings and queens, people with drinks and hors d'oeuvres everywhere. You get time to do whatever you want on your own. We have one meeting that lasts a couple hours. The rest of it is alone time for you and whoever you want to bring with you, or scheduled events that we have, scheduled outings and things like that. It's really first rate. So I encourage you to take a look at Whole Life, take a look at Mutual Trust. Infinite banking concept is a fantastic way to introduce Whole Life into your practice. If you're not using it now, why not? It's 35% of the market. Why wouldn't you fish in the whole pond? That's a huge percentage of the market. And it's not just all captive agents that are selling Whole Life. We're seeing a lot of sales in the independent channel, such as you guys. So I encourage you to take a look at infinite banking, take a look at Mutual Trust, and get signed up. And hopefully we can see you on the cruise in 2020. So with that, Tony, I'm happy to hand it over to you for any questions.
Kip, thank you so much. Let me take a look here. It looks like I'm going to switch it back over to me here. Give me just a second. Okay, so looks like there are a couple of questions here. I'm trying to Comdex rating.
Comdex rating. We are, I can't remember where we are. I think we're in the 70s, but that's because we don't spend the, $50,000 or whatever it is to get rated by two or three other rating agencies. So for every rating agency that we don't subscribe to, we take a 10-point hit. So yes, our Comdex is in the 70s, but it's because we only pay two agencies to give us an A, and we're not going to pay the extra money to get the A's from the others. So that's we think it's a better use of our money. It goes into the dividends instead of going somewhere else.
Okay. And I got another question here, a couple more we'll address. Your underwriting requirements.
We're going to be middle of the road. We do have a unique way of looking at financial underwriting because we do infinite banking. So they can, I can't go into how exactly, but they can look at things in a certain way so that we can get cases done many times from a financial perspective. From a health perspective, if it's a decline from Mass, Mutual, or Penn, it's going to be a decline from us. Okay. Most likely. We don't really have any real niches there.
All right. So from a medical underwriting aspect, it's pretty much the same as any other life insurance company for the most part?
Right.
Okay.
Exactly.
All right. And then let's see here. Trying to read through this. I want to say this is dividends. It says divided rate higher or lower than rate of return. I think it's dividend is what they were trying to say.
Okay. So our guaranteed rate, our guaranteed interest rate is 4%. And the dividend is going to add about another 1.25 to that. So the overall rate's 5.25 roughly.
Okay.
It varies, but that's where it's going to be.
Okay. And I'm going to go one more here. Direct or non-direct recognition?
We get this question often, and I understand where you're coming from with it. We are direct recognition, and we feel that it's more equitable to be direct recognition because then it's recouping some of the costs from those who are actually taking loans on their policy. Instead of giving everybody a lower dividend rate, we're going directly to those individuals that are taking the loans. So, and how it works is not a huge factor depending on how you take the loans. What we'll do is we'll multiply your average outstanding loan for the year times 0.006. So if you have a loan, you take out $20,000, you pay back $10,000, your average outstanding loan is $10,000. We're going to multiply that $10,000 times 0.006, which I think is $60. And then whatever your dividend would have been, we're going to subtract that $60 from your dividend. So if it's, whether it's $100 or $1,000, we're going to subtract $60. Now, the impact is minimal when you're taking reasonable loans. If you take maximum loans on all your cash value in the first couple of years, yeah, it's going to probably wipe out your dividend, but that's typically not what we're seeing. And keep in mind also that our guaranteed cash value, that 4%, which is not impacted by loans at all, that 4% is generating higher cash value on a guaranteed side than our competitors' guarantees plus their dividends. So in the first 6 to 10 years, it's not even an issue. And so by the time you get out to the later years, the dividend's getting pretty strong, and your loans are going to be probably relatively smaller and to the cash versus the cash value. And so the impact will be even smaller as well. So that's a long way of saying that it's not something that has detracted individuals that use us who really understand the infinite banking concept and understand how powerful it is to have those guarantees and accessibility.
Okay. I actually have two more if you can answer real quick, because these are questions that actually come up quite a bit. So I figured we'd go ahead and address these in a forum like this. First question is, how do you handle marijuana use?
I believe it's tobacco.
Mm-hmm.
We treat it as tobacco. I would have to get more details. It's an evolving thing. So I would have to check with underwriting to see, but I believe right now we just treat it as tobacco.
Would that be recreational or medical or one or the other or both?
Yeah, and I think it depends on how much too. So
okay. Right.
I would have to. I really want to get some real authority on that to give you a good answer.
So kind of case by case then.
Yeah.
Okay. And last question is, who are your peer companies and why Mutual Trust is better?
As I've kind of mentioned before, we do very well as far as our guaranteed cash values being stronger than our competitors. So our competitors would be like Penn Mutual, Lafayette Life, Ohio National. We see Mass Mutual from time to time. And again, it's when it comes to this concept in particular, it's that high early cash value that can be accessed at any time that really our clients really appreciate. When you see the cash value growing so quickly, it really helps with persistency because the client can see the money growing in the policy and know that they have access to it whenever they want it. And we're just beyond that, we're a very easy company to work with. You can talk to any underwriter on your case. As soon as you get an underwriter assigned to your case, their phone number shows up next to that case on your business page, in your book of business page. You can call them and talk to them. We have a sales development team that is fantastic and is trained on all of these. Infinite banking is one of our biggest concepts that we partner with, but we have many others we have coordinators for each one on the sales development team. And so they're really good at putting these cases together in the best way possible to help you close this deal. And but just the communication and the ease of working with Mutual Trust it's one of our strong suits.
Okay, so with that, I'm going to go ahead and close the questions. There's a couple of questions that I have from an IAMS aspect. Would you like to get more information on the topic we discussed today? I've got a polling question here that I'm going to put out to everybody. And I'll make sure to get out additional information. So I'll leave this open here for a few more seconds. Quite a few people that want additional information, so that's a good thing.
Good.
Okay, I'm going to close this poll question down. And then lastly, if you're new to IAMS, or even if you've been working with us over the years and you're interested in getting appointed with Mutual Trust or any other carriers that we do work with, here's a polling question in regards to that I'm going to launch, and be sure to reach out to you on that as well. So I'll leave this open here for a little bit. Okay. Looks like we're done there, so I'll go ahead and close that one out. So again, if you guys have any questions at all, please feel free to give me a call. Again, my name is Tony Butler. I'm the Life Sales Director here. You can reach me here at 800-255-5055, or you can shoot me an email at tony@iamsinc.com. That's Tony, Tony, at iamsinc.com. Kip, I want to thank you for taking the time out today to go over the infinite banking concept with Mutual Trust. Looks like we had a lot of people on the call, so I'll be following up with you guys on that. And again, if you have any questions, feel free to give us a call. So with
Thank you very much. I appreciate you listening today.
All right, thank you. So with that, I'll go ahead and close out the call. Again, you guys, thank you for joining, and you have an outstanding week.
Thanks, everybody.
All right. Goodbye, everyone.